Well, good morning, everyone, and welcome to our Kreston Reeves Roundup and Q&A on the 2021 budget. I'm Jennifer Williamson. I'm a partner at Kreston Reeves, and I will be chairing our session today. We are delighted to have so many of you join us. It's been a real stellar turnout. So just a little bit about Kreston Reeves before we dive into the budget detail. So for those of you that don't know us, we're really proud to work alongside our clients to help them achieve their goals, both in the UK and internationally through our Kreston network. At the moment, as you see, you'll find most of us working from home. And post-COVID, of course, there'll still be some of that, but you'll also find our team of over 500 people in our 8 offices across London and the South East. So I think we'll all agree that when Rishi Sunak was appointed as Chancellor in February last year, he could not have begun to imagine what he was walking into. Since then, he's delivered 13 different announcements about financial measures, and on Wednesday he delivered his second budget. So the theme of the budget was very much to reinforce existing support while setting out the roadmap to start the clawback some of the unsustainable debt. Some tax practitioners are calling it a back to the future budget, with several of the measures announced feeling eerily similar to previous tax measures we've had in place, but more of those to come later. So here are some of the top headlines since Wednesday to give you a flavour of the wider reaction to measures that have been announced. I'm finding it hard to celebrate. That's someone saying it's too little, too late for the extension of support to the newly self-employed. The Guardian referring to the support measures announced in the budget, saying that Rishi has extended the safety net. And the BBC suggesting that this is the most important budget for business in a generation. The hope here is that the measures announced on Wednesday will leave business well placed to preserve jobs and grow as we emerge from lockdown. And finally, the ABCD budget: austerity, Brexit, COVID and deceit. The Mirror believed that austerity and Brexit have compounded the damage we felt to the economy from COVID. So we'll be spending the next hour talking you through the headline implications for business and for individuals, as well as the support measures announced on Wednesday. We'll be following this with a Q&A session when you'll have the opportunity to have your questions answered by our panel of experts. So to introduce our panel of experts, we have Andrew Tate, our Head of Restructuring and Transformation, Andy Wallis, our Head of Corporate and International Tax, Daniel Grainge, our Head of Tax, John Walsham, our Business Development and Funding Consultant, Sarah Mannooch, our Director of Legal Services, Rupert Moyle, our Head of VAT, and Terry Burgum, our Financial Planner. So if I can just start with a little bit of housekeeping, there will be a recording of this webinar that will be sent to you all later in the day, along with a short feedback survey, and we'd really appreciate your participation in that survey. IT permitting, we will be asking for a bit of interaction by taking some polls throughout the presentations, and we'll be sharing the results from those polls with you when we send you a copy of the webinar recording. Your questions will be answered by a panel of experts after the presentation, so if you have any questions that you'd like answered, please submit your questions via the question box. So on screen now, you should see instructions for how to raise a question, which we'll leave there briefly while you familiarise yourself with that function. So we'll say goodbye to our panel of experts for now until the Q&A session, and I'll pass you over to Daniel Grainge for our top 5 implications for individuals.
Thank you, Jennifer. Good morning, everybody. My name is Daniel Grainge, and I'm Head of Tax at Kreston Reeves. I'm going to give you a brief overview of the tax announcements in Wednesday's budget that affect individuals. And whilst I'm sure you've seen that there were no changes in the headline rates of tax for individuals, that's not to say that you won't be paying more tax in the future. So the 5 key areas I'm going to cover this morning are income tax, capital gains tax, inheritance tax, pensions and stamp duty land tax. And I'll start with the last of those. So stamp duty land tax, and here's where there's some good news. Since the 8th of July last year, the first £500,000 of the price paid for a residential property has been exempt from SDLT, saving up to £15,000. This SDLT holiday was going to end on the 31st of March, but has been extended to the 30th of June. From the 1st of July, the first £250,000 will be exempt, saving up to £2,500. This saving is lower due to the way the stepped rates of SDLT work. The threshold will then return to its pre-COVID level of £125,000 from the 1st of October. It's worth remembering that the first £300,000 is exempt from SDLT for first-time buyers, and this will continue. And it's also worth remembering that a 3% surcharge applies if you buy a second property, whether that's for you to use or whether it's as an investment property. And this is not included within these short-term reliefs, so you still will pay that 3% surcharge. Moving now to income tax. As you will no doubt have heard and read, no changes were announced to the income tax or national insurance rates. After an increase next month, the personal allowance, the tax-free amount that you can earn, will be frozen at £12,570. And the higher rate threshold, the threshold at which you start paying 40% tax, will be frozen at £50,270. And those will stay at that level until April 2026. This will bring an additional 1.3 million people into income tax by 2026, and a further 1 million people will be paying higher rate tax by that time. The government's own assessment is that this will raise about £8 billion a year by 25-26. And looking at that from an individual perspective, the cost will be £196 a year for a basic rate taxpayer, £734 for a higher rate taxpayer, and £324 for an additional rate taxpayer per year. And additional rate taxpayers are affected less because they already do not have a personal allowance, so future increase in that would not have made any difference to them in any event. I think it's quite interesting that there was no mention of more closely aligning the tax treatment of the self-employed with people who are employed. This was mooted when the self-employed income support scheme was first announced last year. So don't be surprised if this comes back to the table in the future. Moving now to capital gains tax, and despite the Office for Tax Simplification report last year into the future of CGT and the widespread speculation in the press, there was no increase in the rates of capital gains tax. The prospect of increased rates does seem to have fueled activity in the last few months, and I suspect that the revenue have seen significantly increased capital gains tax receipts as a result of that speculation. There's a second report on the future of CGT which is to be published this spring, and we think that it's only a matter of time until a wide-ranging reform of CGT does take place. If you're thinking about selling assets, hopefully this provides you with a period of certainty during which to complete the transaction. Moving on to inheritance tax, and again there were no changes to inheritance tax, and that includes the nil rate band or the threshold that remains at £325,000 and will do so until April 2026. By then, that threshold will not have increased for 17 years, since April 2009. And to put that in some context, if you bought a house for £325,000 in 2009 in the southeast of England, it's probably now worth more than £550,000, a 70% increase. In Greater London, property prices have doubled in that period. Given increasing asset values but stagnant inheritance tax allowances, it really is more important than ever for you to consider your potential inheritance tax exposure and steps that you can take to mitigate that liability. And finally, I want to talk about pensions. Again, there were no changes, with tax relief on contributions remaining the same, no reduction in the annual allowance, and no removal or reduction of the 25% tax-free lump sum, which is all good news. As well as providing tax relief on contributions made, pension funds are also exempt from income tax, capital gains tax, and inheritance tax, so they're an incredibly tax-efficient vehicle to use. However, the lifetime allowance has been frozen at 1.073 million. The lifetime allowance is the maximum value that your pension fund can have before you incur a lifetime allowance charge. Normally that allowance increases inflation each year, but now this will not happen until 2026 at the earliest. To give you an example, if you have a pension fund worth £1 million today and it grows at 4% a year, by the time we reach April 2026, it could be worth just over 1.2 million. This would mean you would exceed your lifetime allowance by 143,000, which could result in a tax charge of almost £79,000 if you take it as a lump sum. So keeping the value of your pension funds under review is going to be absolutely vital to ensure you understand any potential lifetime allowance charges and you can consider the options that are available to you. I'll now hand back to Jennifer.
Thank you very much, Daniel. So it's time for our first poll question now. You heard Daniel talk about the freezing of the inheritance tax threshold. Are you worried that your estate will fall into the inheritance tax net? If we could have yes or no's from the audience. Thank you very much. So next, with the top 5 implications for business, I will pass you over to Andy Wallis.
Good morning, I'm Andy Wallis and I lead our international and corporate tax team. The budget was probably the most significant budget from a business tax perspective for many years. Despite the attention-grabbing announcement of an increase in the headline rate of corporation tax, I think that many businesses will be able to breathe a sigh of relief. This is because the increase in corporation tax is not immediate, and the budget also contains a number of welcome surprises, such as the super deduction tax relief. The increase in corporation tax from 19% to 25% will take effect from the 1st of April 2023. However, small businesses with profits under 50,000 will remain at the 19% rate, and businesses with profits between 50,000 and £250,000 will see the reintroduction of a tapered rate and marginal tax relief calculations, this being one of the Marty McFly moments Jen alluded to. The big surprise in the budget was the announcement of the super deduction, which has been introduced to encourage businesses to invest in new plant and machinery. At present, companies are able to get relief for investment in plant and machinery through capital allowances, typically as an 18% writing down allowance. Companies are, however, also able to benefit from an annual investment allowance of 100%. The annual investment allowance was due to fall from 1 million to 200,000 from 1st of January, but it was announced that there shall be a temporary extension of the 1 million limit for a year. More excitingly, the introduction of the super deduction will enable enhanced relief by providing a deduction of 130% on qualifying capital expenditure incurred from the 1st of April until the 31st of March 23. Businesses will therefore be able to benefit from a tax saving of 24.7p in the pound, being the 19% multiplied by 130%. The attraction is also enhanced because there is no cap on the level of expenditure. There are a number of restrictions to the super deduction, being that it is only available to companies within the charge to corporation tax and that expenditure must be on new assets. It also only applies where contracts were entered into from budget day, and there are anti-avoidance measures to prevent businesses undertaking contrived steps to sidestep this restriction. It is also important to note that in order to prevent abuse, any proceeds received on the sale of an asset which qualified for the super deduction will not be taken into the capital allowances pools, but instead will be a taxable receipt, which is then multiplied by a factor of 1.3. As well as the super deduction, a first-year allowance of 50% was also announced in respect of expenditure on plant and machinery that would normally qualify for special rate writing down allowance. Another welcome support measure announced by Rishi Sunak was the temporary extension of the loss carryback rules. Under existing rules, it is possible for trading losses to be carried back against taxable income of the previous year. The budget extends this carryback from 1 year to 3 years on a last in, first out basis. The intention is that losses incurred by businesses as a result of the pandemic will be able to be carried back against profitable periods prior to the onset of COVID. The operation of the relief will be slightly different for companies and unincorporated businesses. Due to time, I will just talk through the changes to companies now. The changes will apply to accounting periods which end between the 1st of April and the 31st of March 2022. It will still be necessary to apply the normal loss offset rules, which provide that any losses generated can be set against total profits of the period in question, followed by total profits of the previous year. These are as before and remain unchanged and uncapped. Where excess losses remain, the company can elect to carry these back against the 2 previous years, so up to 3 years in total. The carryback is subject to a cap being £2 million per relevant year, and this applies on a group basis, although the cap only applies if an individual carries back losses in excess of a de minimis limit of 200,000. Loss carryback claims will be required to be made in a return and as normal within the 2-year period. However, claims below a de minimis limit of 200,000 may be made outside of a return. Whilst the extension to the carryback of losses is extremely welcome and can provide businesses with a significant cash flow boost, it is important to consider the best use of losses prior to making claims. In particular, given the increase in corporation tax to 25%, will companies be willing to forego a cash flow advantage at 19% now in favour of an additional 6% of tax relief in the future? The measures so far have been applicable to all businesses, but there were some measures that were specifically targeted at those businesses most impacted by coronavirus. Businesses in the UK's tourism and hospitality sector will be able to benefit from an extension to the 5% reduced rate of VAT until September 2021. From October, the rates will then be increased to 12.5% before being increased to the standard rate from the 1st of April. In addition, Rishi Sunak announced the restart grants, which Andrew Tate will talk about later. The budget also announced the creation of 8 freeports, which are designed to increase investment into the economy and stimulate growth. The 8 freeports are the East Midlands Airport, Felix and Harwich, the Humber region, Liverpool City, Plymouth, Solent, Thames and Teesside. So what is a freeport? Essentially, a freeport is a site or area that allows goods to be physically imported into the country, but without any UK duty or VAT being charged until and only if the goods leave the freeport and enter free circulation in the UK. Import declarations are also simplified. If the goods are re-exported before entry into the UK market, no UK VAT or duty is payable. However, as well as this primary benefit, a number of other tax incentives have been introduced for broadly a period of 5 years to make them even more attractive. Companies within the sites will be able to benefit from enhanced capital allowances at 100%, enhanced structure and buildings allowances at a rate of 10%, an exemption from stamp duty land tax on property purchases or leases within a freeport site, full business rates relief, and an employer's national insurance contributions holiday on wages paid to employees within the freeport. So in summary, there is a lot of good news despite the future increase in corporation tax from 2023. With that, I will hand back to Jen, who will introduce Andrew Tate.
Thank you very much, Andy. So for our next poll question, When do you expect to see and feel the signs of the economic recovery? Q3 2021, Q4 2021, the first half of 2022, the second half of 2022, or 2023? It would be great to have the answers from the audience. Thank you very much, everyone. So now over to Andrew Tate, who's going to talk us through the top 5 support measures announced on Wednesday.
Good morning. I'm Andrew Tate. I lead our restructuring and transformation team, and I'm going to give you a quick rundown of the top 5 support measures announced on Wednesday. The first is the furlough scheme. This was extended to September, which wasn't expected, but indicates the length of time the government thinks will be needed to get the economy opened again. I think we're all familiar with the furlough scheme now. It's flexi furlough, it pays the hours not worked by employees, and that continues until June, with the government paying 80% of salary to a maximum of £2,500. The scheme itself continues until September, so in July the government will pay 70% and the employer has to pay 10%, and in August and September the government will pay 60% and the employer 20%. The government did announce funding for another 1,000 investigators into furlough fraud, so do be aware of this. Make sure that your paperwork for the furlough, if you're using it, is absolutely spot on, and please make sure that you pay across the PAYE and the NIC that's due, as the furlough receipts are gross, and that's a real key area for HMRC. There are 2 further grants for self-employed. This is known as seis, which to me sounds like a pair of binoculars, but there have been 3 grants previously which have benefited self-employed people, and we were expecting a 4th grant to be announced. The Chancellor actually announced a 5th as well, which is really good news. This gives self-employed people 80% of 3 months average trading profits. It's capped at £7,500, but the announcement brought into the 4th and 5th grants new self-employed people who only started trading perhaps last year, if they filed last year's tax return before midnight on the 2nd of March, which is basically the day before the budget. It is restricted to self-employed people with their profits of no more than £50,000, which is quite a restriction. Moving on now to the recovery loan scheme. So we're all aware of the CBILS and bounce back loan schemes which were in place last year. There's a new scheme that's going to run from April through to the end of the year, and this allows businesses to borrow up to £10 million with government government guarantee to the banks of 80%. You can apply for this even if you had a CBILS or bounce back loan in the past. There is a difference. There is no interest-free term. So there was an interest-free term for CBILS and bounce back for a year. This doesn't have that. Any loans of less than £250,000 don't require a personal guarantee from the bank. So it's a good scheme. It will be interesting to businesses, but it is more debt to pay back afterwards. So there's some careful planning needs to be carried out there. In terms of business rates, the business rates holiday for hospitality, retail and leisure businesses has been extended. It's been extended in full to the 30th of June and at 2/3 of full rates until the end of the year, which is 31st of March 2022. So that's a good break for hospitality, retail and leisure businesses. It doesn't apply to others. In the same vein, restart grants are going to be available for certain sectors. So these follow the previous grant funding, which was administered by local authorities, and this will be too, a funding provided by government to local authorities to support local businesses. It's based on each premises which a business owns, and essentially all non-essential retail, which will open up first, will be able to apply for £6,000 per premises. Hospitality and other businesses which are only allowed to open later in the government's roadmap, they'll be able to claim £18,000 per premises to reopen. Do remember that these grants are subject to state aid limits. That's quite an important point for larger businesses, and there are some articles on our website about this. I just also quickly wanted to mention Future Fund. This is a scheme which has been in place to encourage investment into innovation and R&D companies, and there is a new 375 million scheme that's been announced, which will be brought in this year. And this provides for businesses to borrow a minimum of £20 million, but to encourage them to take government investment, but also to bring in private sector involvement too. I'm going to hand back to Jen.
Thank you, Andrew. So the questions have been coming in thick and fast whilst you've all been speaking. Please do continue to submit them. There's the guidance again on how to do that. I would say if we're not able to answer all your questions today, then one of our experts will follow up with you after the webinar to make sure we cover your query. So to the questions. So first of all, I've got a question asked by Christopher. Dan, this would be a question for you. Following on from the budget, I would be interested to understand whether dividends still remain the most tax efficient route when compared to PAYE, so through salary, for extracting profits, assuming higher earners and a 7-figure extraction.
Thank you, Jen, and that's a really good question, and one that we've been asked lots of times in advance of today and already this morning, so it's obviously a key issue. Just as a bit of background, there are a couple of ways of extracting income from your company as salary, which is subject to PAYE and national insurance, both by the employee and the employer, and that is a tax deductible expense for the company, so reduces the company's corporation tax liability, or as dividends, which are not tax deductible but are taxed at lower rates for the individuals. Despite the marginal rate that Andy described, which between 50,000 and 250,000 is going to be an effective rate of 26.5%, it is still, in the vast majority of cases, going to be more tax efficient to take dividends rather than salary. There are going to be a couple of exceptions to that. For example, if you've got self-employed losses, potentially if you're above state retirement age and so you don't have to pay employees national insurance, that may change the decision. But as I say, in the vast majority of cases, taking dividends is still going to be the more efficient route to follow.
Thank you very much, Dan. Useful to know. We've had a number of clients asking that question already. So this is a question for Terry. Terry, this question is coming from David. My pension benefits are already above the lifetime allowance. What impact will freezing the lifetime allowance have, and what steps should I take to reduce my future excess tax charge?
Thanks for that. I don't know if you can hear me. I'm having a bit of trouble with my camera at the moment, so you can't see me, but can you hear me, Jen?
I can hear you, Terry. Thank you.
Okay, well, I apologise that I'm not on the screen at the moment, but it's a good question. So there's two parts to that question. One is about how much it will cost. So if we consider that the lifetime allowance was set to increase by 0.5% on the 6th of April, if we consider similar increases each year for the next 5 years, the freezing of this allowance may cost you up to £15,000 in extra tax charge when you come to crystallise your benefits. And of course, if inflation was higher over that period of time, then the cost will be greater. What can you do to maybe combat that? Well, there are a number of different strategies, but one common strategy is that if you're over age 55, you may consider crystallising benefits up to your available lifetime allowance immediately. This would trigger the payment of your 25% tax-free cash lump sum, if you wish to take that, which you could then reinvest outside of your pension, where any future growth wouldn't be subject to the lifetime allowance tax charge. This may also soothe any concerns you've got about the 25% tax-free cash lump sum being withdrawn at some future point. The remaining funds can then stay within your pension, where they will not face any further lifetime allowance tests until age 75 and benefit from gross roll-up of investment returns. However, there are a few trade-offs to consider to this strategy. One being that funds withdrawn from your pension would enter your estate and then therefore may be subject to inheritance tax on your death. And you will also, of course, miss out on any future increases in the lifetime allowance post 2026. So as always, it's important to take advice around your individual position to make sure that there isn't any unintended consequences from the actions you take. Thank you.
Thank you very much, Terry. So we've got a legal question now, so I'll pass this to you, Sarah. This has come in from Phil. I was looking to review my will, but there was no mention of inheritance tax changes in the budget. Do I still need to do this?
Oh, thank you for that question, and thank you, Jen. So my name is Sarah Mannooch, and I'm a solicitor and I'm Director of Legal Services here at Kreston Reeves. So Phil, you're quite right, and as Dan mentioned earlier, there haven't been any changes to inheritance tax in the budget. And we do now have clarity that the nil rate band is going to remain at the same level until April 2026. So that level is £325,000. Dan also mentioned that that's stagnating at the nil rate band, and with increases in property prices and values and asset values, it is likely that more individuals will fall within that IHT net in the next 5 years. So whilst there haven't been any changes, it would still be a good idea for you to review your will to make sure that you're taking advantages of all of the reliefs and the nil rate bands that are available to you. Now, inheritance tax is a very good reason to review your will, but it's not the only reason. I ask my clients to consider their will as an active document. I would suggest to them that they review it at least every 3 to 5 years, or if they have a more complex estate, more often. And I also tell them that there are various different life events, trigger events that they should look out for them to review their will. So things like death, divorce, not just their divorce, but children's divorce, births, marriages, but also financial events. So things like asset restructuring or changing their investment patterns. And they're all things that might trigger you to review your will. And if you're taking advice from my colleagues in tax and financial planning, then you may well be making changes in the next year. So reviewing your will should be something that automatically follows on from those things. And of course, if you are looking to review your will, Phil, you're very welcome to contact me and my team, and we'll be very happy to help.
Thank you, Sarah. Andrew, you might know the answer to this question, Andrew Tate. We've had a question from Graham. Will the extension of support in relation to business rates apply to estate agents as it does in the current year?
Thank you, Jen. Interesting question. Estate agents were brought into the business rates holiday last year, so I don't see any reason why that shouldn't continue into this year. It hasn't been explicitly outlined by the government in their budget announcements. No doubt we'll see more of that, but I think certainly it should do. You know, estate agents have been able to operate on a limited basis, but their businesses still have been impacted.
Thank you, Andrew. We've got a question from Paul here. I think it's probably going to span a couple of our experts. Paul has asked, is there any assistance for companies investing in improvements to business? Maybe Andrew Wallis, you could start us off on that.
Thank you, Jen. Yes, Paul, I think there are some significant measures that could help you. I think from a tax perspective and a corporate tax perspective, the main one is this new super tax deduction, which will mean that companies investing in their plant and machinery will be able to get 130% deduction for their expenditure. And that effectively equates to a 24.7 pence in the pound for their expenditure, which they will get relief for. I think there are a number of other measures and probably the loan schemes. And maybe if I hand over to John, who can talk through that.
Yeah, morning everyone. As Andrew's talked about the recovery loan scheme and given you the headlines, remember that the CBILS facility is still available until the end of March. You've still got access through the CBILS scheme to put your application into a lender by the end of March to benefit from the 12-month interest-free period and no fees. With the recovery loan scheme, as the details are at the moment, it will be a commercial rate of interest together with fees payable. If you access potentially an application before the end of March, to invest in some items to improve your business, then you would be potentially putting off those repayments for 12 months and having no fees to pay. In addition to that, if it's below 250,000, you would have no personal guarantee, as Andrew touched on before. So I think there are some quite significant benefits in thinking about what purchases and investments you want to make in, say, the next 6 months, because most CBILS loans that are granted to you, say by the end of March, would generally have 6 months before you need to draw the loan down. So you could still access the CBILS scheme rather than waiting for the recovery loan scheme, which could actually be more expensive to you. So it definitely seems sensible to review what investments you want to make, how those could be funded, and we'd be very happy to help with that. I work within the funding team here at Kreston Reeves, and we have access to over 100 lenders where we can support our clients. Thanks.
Thank you, Andy and John. We've got a question here from Gary. I think I'll direct this to Andrew Tate. How do you register for seis, the Self-Employment Support Scheme?
Thanks, Jen. So the previous the way that you've applied for the previous 3 grants has been through the government gateway. So through your taxpayer gateway, you go in through that and you apply for them. The government hasn't yet issued its guidance as to how the 4th and 5th grants will be applied for, but I'm pretty sure it will be the same. So it's by using your own portal through to HMRC.
Thank you, Andrew. We've got another one for you here. This is a question from Mike. Is the furlough scheme extended open to companies who haven't used it before?
Thank you. So when furlough was first put in place, there were certainly some limitations that employees had to be employed by a company by a certain date for them to be able to participate. That was then eased up as we went through 2020 with the furlough scheme. We haven't seen anything specific that would limit the date on which an employee had to be taken on by a company. So I think that it's going to be a case that if you haven't had employees on furlough before, you should be able to bring them into this. But keep on looking out for any limits that the government might put on that.
Thank you, Andrew. We've got a question for Dan now. Dan, this is a question from Pat. She's asking, how does the budget affect sole trader landlords?
I think the simple answer to that is it doesn't in particular, or doesn't particularly for landlords, apart from, as I said earlier, the freezing of the tax-free personal allowance and the higher rate threshold. So there were no changes to the tax treatment of rental income or the deduction of mortgage interest and things like that. And the super deduction that Andy talked about earlier is only available to companies, so would not be available to sole traders. So no significant changes in the budget that apply to sole trader landlords.
Thank you, Dan. We've actually got a VAT question now on the Freeport. Rupert, this is directed at you. So for manufacturing businesses, for example, have been struggling to get to grips with the new import and export rules following Brexit. Clearing customs is not straightforward, and achieving zero duty under the origin rules is also far from being a given. So how will Freeports help in that regard?
Thank you, Jen. Well, I think Andy's covered the point as to the main purpose of Freeports. They're not actually a new concept. They were around since 1984 to 2012 in the UK. But I think if you're lucky enough to get a spot in a Freeport, the main benefit there is to do with exporting goods, re-exporting goods. So if goods come into the UK, then they're never actually brought into the free market or in free circulation in the UK, but are re-exported. No UK duty is paid at all. So that's the main benefit, but there are some little nuances there. So for example, we do have quite a number of clients at the moment who import into the UK, and now following Brexit, when they try and move those goods over to the EU, they're paying both UK duty and then EU duty, so a double hit. So what a Freeport does is, if you're set up in a Freeport, it allows you to import the goods into the UK, not pay UK duty. If the goods are re-exported without actually entering the UK market, then you're only going to pay one amount of duty in the EU. The other little nuance is that if you bring in some materials with, say, a high rate of duty into a Freeport, and out of those you create a finished product which attracts a low rate of duty, then by not paying the high rate of duty on the original materials and only paying the low rate of duty when the goods enter free circulation, you're achieving a saving there. So the main issue there, I think, is, or the main benefit is to do with duty, but there's also going to be some customs simplification measures. So in terms of the import declarations, they will be easier. It's not going to help with VAT. At the moment, since Brexit, we've introduced postponed VAT accounting in the UK. What that means is that you can self-account for and recover import VAT on your VAT return if you wish, rather than paying to the port. So it's of no help there. It really is about savings on duty and administration.
Thank you very much, Rupert. I'm just going to come back to Andrew Tate briefly, because I think we have an update on how the furlough scheme can be accessed for people that haven't used it before. Andrew.
Thanks, Jen. Yeah, just had some clarification come through on that point that was raised about can employees who haven't been on furlough before be brought into this scheme? And the answer to that is actually that if an employee was an employee on the 2nd of March, then they can be brought into the scheme. You have to submit a real-time submission for the PAYE, etc., to back that up. But that's the answer.
Thank you, Andrew. I've got a question for Andy Wallis here. This is asked by John. Please could Andy provide an example of how the super deduction will work versus current AIA position?
Thank you very much. Yes, I can certainly do that, John. Just to summarise, the super deduction will give a 130% tax relief for investment in plant and machinery, and there's absolutely no cap on the maximum expenditure. For the AIA, there's 100% relief, so slightly less, and there is a £1 million cap on that expenditure. I've just pulled up an example that the Chancellor actually used, so I'm just going to read this. He took the example of a business spending £10 million on qualifying plant and machinery, which will be able to obtain a tax deduction of £13 million, which is a tax saving of £2.47 million. The same expenditure currently would only qualify for the £1 million annual investment allowance and an 18% writing down allowance in that year. And that's a tax saving of just under 500,000. So hopefully that example clarifies things for you.
Thanks, Andy. And if we could just also cover off a question that's come in from Jackie. She's asking, is there a list of the qualifying spend for the super deduction?
Yes, largely it's items that you would get normal capital allowances for at the moment. There are exclusions, so your special rate pool items, things like cars, etc., are excluded. We can certainly follow up with any specific questions that Sue has if she'd like.
Thank you, Andy. So we've now got a question for John. John, someone has asked, I have a CBILS or bounce back loan, so can I apply for another loan from the recovery loan scheme?
Yeah, absolutely. Absolutely. That's what it's designed for. What's not clear yet is whether you would potentially repay the existing loan and have a full loan, because you can borrow up to £10 million per business on the recovery loan scheme. So the answer is yes, you can. It can run alongside, and it may be that there's a way in which it can be amalgamated with the existing borrowing, but that could be discussed. Just some top tips when you're thinking about looking at the recovery loan scheme. Think about the personal guarantee below 250,000. So absolutely always approach your existing lender for their support, but also think of the benefits potentially if you borrowed, say, currently 200,000 and you need another 250. If you did that with the existing lender, then you would need to provide a personal guarantee, potentially. If you actually used a different lender for this next tranche, below 250,000, then you would have no personal guarantees. There is a possibility in that scenario where you'd have 450,000 borrowed, but not providing personal guarantees on either debt. I'm not suggesting you run around looking at lots of different lenders all the time. I'm just saying think of the options, and we'd be happy to help you.
Thank you, John. We've got a question from Gillian now. Gillian asks, in relation to Freeports, will a business have to be involved in import or export to benefit from the various incentives? i.e., could we buy or rent a property in the Freeport in order to support the business there? Andrew Tate, I don't know if you could answer that one for us. You're on mute, Andrew.
Thanks, Jen. I don't know whether Rupert has got any thoughts on that, but I think we'll have to look into that one, and perhaps we can go back a little later in the webinar on it.
Yes, I don't know, Andrew. I think that these are starting later in the year, so we're going to receive more detail then. But we'll look into it and see if we can help.
It's a great idea.
Some more detail to come on that, Gillian, and we'll be in touch when we take your contact details to make sure we follow up with you on that. And Sebo has asked, how does a company get a spot in a Freeport? Again, I suspect we're not quite sure yet. Anyone got any ideas from the panel on that?
I think that's right. I don't think we know exactly. My understanding is that the Freeports can be up to 27 miles in size, but I don't think we've got the precise locations of those Freeports. We know roughly where they will be, and then I think it's really a question of whether you relocate into those areas or whether you can qualify by potentially already being existing in those areas. I suspect that you will need to actually move into the area in order to qualify, but we can certainly look at the detail as that comes through and get back to you.
Thank you very much. So a lot more to come on Freeports. I think there's a lot of information we're still waiting for. Andrew Tate, this would be a question for you, I think. Is the £1,000 payment for keeping furloughed employees on still in play?
So the straight answer to that is no. That scheme was actually retracted or scrapped by the Chancellor in November when he extended furlough at that time. He has said that there will be something coming back, so I think that as we get further through to September, we may well see that coming back in, but at the moment there's nothing on the table.
Thank you, Andrew. This question has been asked by Daniel. I suspect we should probably direct this to Terry. I'm approaching pension age. What should I be looking at doing? And is there anything from the budget I should be wary of? So probably Terry or Daniel. We'll start with Terry.
I don't think there's anything to be too wary of from the budget. I mean, it does depend on your personal details, Daniel, and whether or not you're over the lifetime allowance. Apart from that, there's no real change to what you should have done before, which is really consider obviously the best options that are available from your pensions to meet the income you require in retirement, and of course just take advice is always my first recommendation.
Daniel, is there anything you'd like to add?
Yeah, thanks, Jen. Just adding to what Terry said, I think it's worth remembering that in certain circumstances you can use previous year's pension annual allowances, so to catch up on any pension contributions that you haven't made. So I think depending on your level of income and what you've done in previous years, it may be worth looking at that to get tax relief on those contributions. But as Terry said, very much down to personal circumstances and getting advice.
Thank you. So we've got a question here that's been asked by Andrew. I am a sole trader. I missed out on the financial support because my profit was more than £50,000 per annum. I've not received any financial support at all. Is there anything in this budget for me and millions like me? I've been living off my savings, but a year is tough and I'm running out of money by the summer. I think we'll start by directing that to Dan.
I'm not aware of any further support there. I think that's probably one for Andrew Tate if he's got any other anything else to pick up. But I think unless there's been a reassessment of that 50,000 level based on the 19-20 tax returns, I'm not aware that there's any further support. But I don't know whether Andrew can add any further detail to that.
Dan, I think that's absolutely right, unfortunately. Certainly the self-employed grants out there are definitely limited at the 50,000 profits, which is unfortunate. I think that the only other angle on this really is the loans, the loan recovery scheme. Certainly lots of self-employed traders have been able to pick up on the bounce back loan, and that's been heavily used. Clearly it is more debt that has to be repaid, and that's the disadvantage. It's not a grant, but I think that's the only option really, unfortunately.
Thank you, Andrew. We do have a question for you here, Daniel. You talked about the impact of property prices on inheritance tax liabilities. This person has a rental property that has increased in value significantly since they bought it. What options are available to try and reduce their inheritance tax exposure?
Thank you, Jen. Generally, when we're looking at inheritance tax planning, it involves giving away assets, particularly at a time when you're going to live for a further 7 years. So one possibility would be thinking about giving away that rental property. There are a number of factors to consider there, particularly if it's gone up significantly in value, that there's likely to be a big capital gains tax charge there. It may be possible to defer that by giving the property to a trust rather than into individuals, but there are some limits on that before you start triggering a lifetime inheritance tax charge. So it depends on the value of the property as to whether that's possible and whether it's in your sole name or joint names. The other really important thing to think about when you're thinking about planning with rental properties is whether there's a mortgage secured on the property, because moving it with the mortgage could be difficult because of the mortgage company, but also it can result in stamp duty land tax charges. So lots of things to think about there, but there are certainly options available to you, either as an outright gift to individuals or thinking about that trust route, as I say.
Thank you, Daniel. We have a question probably for John and Andrew Tate here about restart grants from Dawn. Dawn is asking, non-retail is up to £6,000 and hospitality is up to £8,000. Do you know the calculations or eligibility? Should we start with you, John?
Thank you, and it's always right to be very honest. And no, I don't know the detail of on that individual point. I know from local authorities there's a lot of guidance and help around what is applicable and what is eligible. So in circumstances I've seen over the last month, it's been about approaching the local authority and looking in detail at what the eligibility criteria is. Andrew?
Thanks, John. I think that one of the answers to this is it does depend on the rateable value of the property. So the 6,000 and the 18,000 that I mentioned for these grants are the top end, and I don't know the exact numbers, but the property rateable value has to be at a certain level to get that full amount of grant. The grant is then scaled down if you have a smaller property. So I don't think we have the detail on this particular grant, but certainly that's how it's been done in the past.
Thank you, John and Andrew. I think we're coming up to some of our final questions. We've got one for you, Rupert. In this budget, the Chancellor seemed to be planning to recover some of the aid it has given to businesses during the pandemic by way of a rise in corporation tax. We've seen nothing in that regard for VAT. Why is that, and do you think there will be changes ahead?
Thanks, Jen. I don't think it was a good time to raise the rate of VAT because the government has been trying to protect the very businesses that would be affected if we raised VAT. So, for example, hospitality, attractions, those sort of, and catering, those sort of businesses. If you raise VAT, they were the ones who are having to charge the extra amount. And whilst we're trying to get them back on their feet and support them, it wouldn't have been a good idea. And indeed, you will have seen the 5%. Continuing 5% rate for those sectors, moving up to 12.5% until the end of March next year. So I think that's why it wasn't raised. But if you're asking, what's going to happen in future? Well, VAT is a really big earner for the government. I think it's probably number two, a close second. So it's a very good way of raising tax. So I can see us going up. perhaps in the next year or two, when things calm down a bit and when the economy's moving forward. You know, after all, if you look at Europe, the rates are between 17% and 27%, so we're still quite low. We're around about the same sort of mark for France and Germany, you know, the if you like, direct competitors perhaps, but there's certainly scope to move upwards. And the other point I think is that now we're out of the EU, we've got the freedom to do what we want, which is why you saw the 12.5% being introduced for the leisure sector. I think there's going to be some interesting changes ahead. You know, the 2017 VAT Office of Tax Simplification report suggested a number of reforms that were necessary, and I think we can now do those. So I think the excitement is to come. Thank you.
If I can just maybe chip in very quickly there, I think the point that Rupert made about VAT being a big revenue riser is absolutely right. To put it in context, corporation tax accounts for about 10% of the HMRC receipts. So I think that's why there's been quite a big increase in corporation tax to offset that, whereas potentially a much more modest increase in VAT could have had the same impact.
Thank you very much. I think that probably calls time on the questions we've got time for now. I'm conscious that everyone has places to be from 10 o'clock, I'm sure. We've been delighted that so many of you could join us, and thank you to our panel for those insightful answers into the announcements from Wednesday. We do have one final poll question for the audience. Do you think you will be better or worse off as a result of this week's budget? Thank you very much. So if there are any additional questions or matters that you would like to discuss further with our team, then please just leave a brief description of these in the pop-up survey at the end of the webinar, and we will be in touch. And as I previously mentioned, if we haven't been able to answer your question that you submitted today, one of our experts will be in touch with you shortly. So that leaves me to say thank you very much, everyone, for joining us. Thank you to our panel. Please stay safe and keep well, and we do very much hope to see you all in person soon.